I'm going to talk a little bit about the general process for doing an IPO or an issue, even if you're a public company. A couple of key terms. So there's two types of deals that an investment banker can arrange with you. Okay, so the first one I'll call best efforts. And this is a scenario where the underwriter, and the underwriter is the investment bank, sells your shares for commission. Okay. And if they're unable to sell all the shares that you want, then the unsold shares will be returned. Okay, so essentially, if you look at it here, the risk is with the company. The company that's doing the IPO has the risk that if it's a failed IPO or it's not as much interest as you would normally expect, they're going to get whatever is unsold back. The second type is called a bought deal. And in this case, the underwriter buys all the shares. At right here at a slight discount. So maybe 0.5% or 1%. They'll take a lower price, and then they will ultimately sell to the ultimate shareholders or the new investor. Okay, so in this case, they bought all the shares. If they can't sell them, then they're sort of stuck holding them until they find a buyer. So the risk is with the underwriter. Okay, so investment banks usually like to do best efforts deals. When the economy gets tough, then in order to get competitive, they'll enter the bought deal area, but it's not optimal for them. And then there's also the concept of a syndicate. This is where multiple investment bankers will get together to do a deal if it's a very large deal. So I'll call this a group of investment banks. Okay, they will work together as essentially the underwriter. And you would say, why would they do this? It does split their commission, but it essentially lowers the risk. So you don't have the entire risk with one investment bank. If something fails, then it's spread amongst a group of people or a group of different investment bankers. Now, there's one really big concept of issuing equity, and that's particularly with an IPO. It's underpricing. It's where you set the price of the shares slightly below what you think it is. Okay, so this can be any number that you want it to be. It generally tends to be, you want to approximate it at less than 10% discount. Okay, if you put it too low, then you're giving away pieces of your company. If you put it too high, there won't be enough demand. So essentially the goal of this is to create a buzz for your shares. Okay, so you're issuing you're issuing shares of your company for the first time in the public market. You want people to be really excited and say, I want to buy shares of this company. And if you set it at a discount, it encourages them because they think they're going to make a quick profit right away. Okay, so they'll buy it, and it's essentially a form of advertising. Okay, and it also, why would you do it? It also makes it easier for the underwriter to sell the shares. So there's no point in doing an IPO if you're really having a hard time selling out or you have to return shares. And the third thing is that it's expected. Okay, so when an IPO is issued, it is expected to have a underpricing built into it. If you do not, if you say, I'm going to issue these shares at $30 a share, and that's actually the true value, there's not really any great incentive to go buy the IPO. You could say, well, why don't I just let it trade on the market and I'll buy it the next day. We'll see what happens. But if you think that it's actually going to go to 35 or 40, then you're incented to go in and buy it. So this is usually, out of all the costs of setting up the IPO, you pay investment bankers and lawyers and all that kind of stuff. Underpricing is usually the largest cost. Because if you get it wrong, you could be giving away 10-20% of your company unnecessarily. And you know, existing shareholders aren't going to be too happy about that. So that is an IPO. The other concept is an SEO. This is a seasoned equity offer. And this essentially is just a public share issue for a company that is already trading on the market. Okay, so for example, if Apple decided to raise some money through equity, they would issue shares. Apple's already a public company, so they're not doing an IPO, they're doing a seasoned equity offer in that scenario.